Welcome back to our Foundation to Accounting course. In this lesson, we are going to step back and look at the full journey of accounting. This lesson is about the accounting cycle. The accounting cycle is the complete process accountants follow to record, organize, summarize, adjust, and report financial information. Where we are in the course. In Lesson 1, we learned what accounting is and why it matters. In Lesson 2, we learned the accounting equation. In Lesson 3, we learned the double entry principle, which explains why every transaction must have at least two sides. Now, in this lesson, we are looking at the full journey of accounting. Many beginners struggle because they learn journal entries, ledgers, trial balances, and financial statements as separate topics. But these topics are not separate. They are all connected. They are all stages in one journey, and that journey is called the accounting cycle. By the end of this lesson, you should understand what the accounting cycle means, why it is important, the stages of the cycle, how transactions become financial statements, and why this lesson is important for students and business owners. Why this lesson matters for students. If you are a student, this lesson is important because it gives you the map of accounting. If you do not know the map, every topic may feel confusing. The accounting cycle shows where each topic belongs. It helps you understand the order of accounting activities, connect journal entries to ledgers, connect ledgers to trial balance, understand why adjustments are needed, prepare better for exams, and think like an accountant. If you are a business owner, this lesson helps you understand how daily business activities become financial reports. Financial statements do not appear from nowhere. They come from daily transactions. If the transactions are not recorded properly, the reports will not be reliable. The accounting cycle helps you appreciate why receipts and invoices must be kept, why transactions must be recorded on time, why bank reconciliations matter, why unpaid bills and customer invoices must be tracked, why month-end adjustments are important, and why financial reports depend on accurate records. What is the accounting cycle? The accounting cycle is the step-by-step process used to record business transactions and prepare financial statements. It begins when a transaction happens. It ends when financial statements are prepared and the accounting records are closed for the period. A period may be 1 month, 1 quarter, or a year. The accounting cycle map. The accounting cycle usually includes identifying transactions, recording transactions in the journal, posting to the ledger, preparing the trial balance, making adjusting entries, preparing the adjusted trial balance, preparing financial statements, and closing the books. In this beginner lesson, the big journey is transaction, journal, ledger, trial balance, adjustments, and financial statements. Stage 1. Identify business transactions. The first stage of the accounting cycle is identifying transactions. A business transaction is any event that affects the financial position of the business and can be measured in money. Examples include owner investment, buying goods, selling goods, paying rent, paying salaries, borrowing money, buying equipment, receiving payments from a customer, and paying a supplier. Not every activity is an accounting transaction. A discussion about a possible sale is not yet a transaction. The key question is whether something has happened that affects money, assets, liabilities, equity, income, or expenses. Source documents. Evidence of transactions. Before transactions are recorded, accountants need evidence. This evidence is called a source document. A source document is the original record that proves a transaction happened. Examples include receipts, invoices, bank statements, purchase orders, sales orders, contracts, payment vouchers, credit notes, debit notes, payroll records, and deposit slips. Source documents help accountants know what happened, when it happened, how much was involved, who was involved, and which accounts are affected. Stage 2. Record transactions in the journal. After identifying and analyzing the transaction, the next step is to record it in the journal. The journal is the book of original entry. A journal entry shows the date, the account to debit, the account to credit, the amount involved, and a brief explanation called narration. For example, when the owner invests 10,000 Ghana cedis cash into the business, cash increases and capital increases. The journal entry is debit cash 10,000 Ghana cedis and credit capital 10,000 Ghana cedis. The narration will be being cash introduced into the business by the owner. Stage 3. Post to the ledger. After transactions are recorded in the journal, they are posted to the ledger. The ledger is the book or system where transactions are grouped by account. In the journal, transactions are recorded by date. In the ledger, transactions are organized by account. This helps the business know the balance of each account, such as cash, accounts receivable, accounts payable, sales, and rent expense. Journal and ledger are connected, but different. You can think of the journal as the diary of transactions and the ledger as the organized filing system. The journal records what happened day by day. The ledger groups similar items together. The journal answers what happened and when. The ledger answers what happened to each account. Stage 4. Prepare the trial balance. After posting transactions to the ledger, the next stage is preparing the trial balance. A trial balance is a list of all ledger account balances at a particular date. It shows debit balances and credit balances. Its purpose is to check whether total debits equal total credits. If total debits are 50,000 Ghana cedis and total credits are 50,000 Ghana cedis, the trial balance balances. The trial balance is useful, but not perfect. It is important to understand that a trial balance does not prove that everything is correct. It only proves that total debits equal total credits. Some errors may still exist even when the trial balance balances. For example, if the wrong account is debited and the wrong account is credited with the correct amount, the trial balance may still balance. A balanced trial balance is a good sign, not final proof. Stage 5. Make adjustments. After preparing the trial balance, accountants may need to make adjustments. Adjustments are made to ensure that income and expenses are recorded in the correct accounting period. Sometimes, a business may have earned income but not yet received cash. A business may have incurred an expense but not yet paid cash. Sometimes a business may have paid for something in advance. Sometimes an asset may have been used over time and needs depreciation. Adjustments help prevent profits from being overstated or understated. Let us look at two simple adjustment examples. Suppose a business pays 12,000 Ghana cedis for 1 year's rent in advance. If the business prepares monthly reports, it should not treat the full 12,000 Ghana cedis as rent expense in 1 month. It should recognize only the portion that relates to each month. Another example is unpaid salaries. If workers have worked for the month but salaries have not yet been paid, the salary expense has been incurred and must be recorded. Stage 6. Prepare the adjusted trial balance. After adjustments are made, the business prepares an adjusted trial balance. It is prepared after all adjusting entries have been recorded and posted. It shows the final account balances that will be used to prepare the financial statements. Before adjustments, the trial balance may not show depreciation expense, accrued expenses, or accrued income. Stage 7. Prepare financial statements. After preparing the adjusted trial balance, the next step is preparing the financial statements. Financial statements are the final output of the accounting cycle. The main financial statements include the income statement, the statement of financial position, statement of cash flows, and statement of changes in equity. For beginners, we will focus mostly on the income statement and the statement of financial position. Stage 8. Close the books. The final stage of the accounting cycle is closing the books. Closing the books means ending the accounting period and preparing the records for the next period. Temporary accounts such as revenue accounts, expense accounts, and drawings or dividends are closed. Permanent accounts such as assets, liabilities, and equity are not closed. They are carried forward to the next period. Let us bring everything together with a simple story. Majesty Nuts Cashew buys raw cashews, buys packaging materials, sells products to customers, receives cash from customers, supplies some shops on credit, pays rent, pays workers, receives a utility bill, and buys a small sewing machine. At the end of the month, the owner wants to know whether the business made a profit, how much cash remains, how much customers owe, how much suppliers are owed, how much inventory is left, and what the final position of the business is. How Majesty Nuts activities become financial reports. The accounting cycle helps answer the owner's questions. First, each transaction is identified. Then source documents such as receipts, invoices, and bank statements are collected. Then the transactions are recorded in the journal. Then they are posted to ledger accounts. Then a trial balance is prepared to check whether debits equal credits. Then adjustments are made for unpaid bills, prepaid expenses, or depreciation. Then the adjusted trial balance is prepared. Finally, the financial statements are produced. Why the accounting cycle matters? The accounting cycle matters because it creates order. Without the accounting cycle, financial information would be scattered and confusing. A business may have receipts in one place, invoices in another place, bank statements somewhere else, and memory-based records that are not reliable. The accounting cycle brings discipline to the process by ensuring that transactions are identified, supported by evidence, recorded properly, grouped by account, checked for balance, adjusted correctly, and reported clearly. Common beginner mistakes. Beginners often make a few mistakes when learning the accounting cycle. One mistake is thinking the journal and ledger are the same. They are connected, but they are different. Another mistake is thinking the trial balance is the final report. It is not. It is a checking tool. Some beginners ignore adjustments, but adjustments may still be needed even if the trial balance balances. Others think financial statements are prepared directly from receipts, but receipts are only source documents. Finally, some learners see each topic as separate, but they are actually connected stages in the accounting cycle. Here is a simple way to remember the accounting cycle: transaction, journal, ledger, trial balance, adjustments, financial statements. You can also remember it as a story. A transaction happens, the journal records it, the ledger groups it, the trial balance checks it, adjustments correct it, financial statements report it. This is the accounting cycle in simple language. Let us recap what we have learned. The accounting cycle is the step-by-step process used to record transactions and prepare financial statements. It begins with identifying transactions and ends with financial reporting and closing the books. The journal records transactions in date order. The ledger groups transactions by account. The trial balance checks whether total debits equal total credits. Adjustments help ensure income and expenses are recorded in the correct period. Financial statements are the final output of the accounting cycle. Most importantly, the accounting cycle shows that accounting is not random. It is a logical process. In this lesson, we have seen how accounting information moves through the full process. Now we are ready to move into theory from practice. In the next lesson, we will discuss what a business transaction is. See you in the next lesson.